Some people believe real estate is the ultimate path to wealth. Others argue stocks outperform everything else over time. But here's the issue. Most comparisons are completely misleading. People usually compare rising home prices against stock market returns, while ignoring the factors that matter most: leverage, taxes, rental income, inflation, maintenance costs, dividends, and opportunity cost. So in this video, we're looking at the real numbers. By the end, you'll understand which investment tends to create more wealth, why real estate can appear more profitable than it really is, and the specific scenario where real estate massively outperforms stocks. Let's get into it. The reason this debate keeps happening is because both sides only highlight the numbers that help their argument. Real estate investors say, I bought a property for $300,000 and now it's worth $800,000. Stock investors say, the S&P 500 averages around 10% per year, but neither tells the full story because real estate relies heavily on borrowing. Stocks are easy to buy and sell. Real estate can generate monthly income. Stocks compound automatically over time. Real estate includes hidden expenses. Stocks come with volatility. So instead of opinions, let's compare both using actual math. Historically, the U.S. stock market has returned roughly 10% annually before inflation. After inflation, closer to 7%. Now imagine investing $500 every month for 30 years with a 10% average annual return. Over those 30 years, you contribute about $180,000, but your portfolio grows to around $1.1 million. That's the power of compounding. And one major advantage of stocks is simplicity. They're passive, liquid, diversified, and highly scalable. No tenants, no repairs, no emergency maintenance calls. But there's one thing stocks don't offer as effectively as real estate. Real estate has one enormous edge over stocks: leverage. With real estate, you can control a large asset using relatively little of your own money. For example, you purchase a $500,000 property using 20% down, or $100,000. If that property increases in value by 5%, that's a gain of $25,000. But remember, you only invested $100,000 up front, so your return isn't actually 5%. It's 25%. That's why many real estate investors build wealth so quickly. Leverage amplifies returns. But there's another side to that equation. It also amplifies losses. Most people focus only on appreciation. That's a mistake, because owning property also means paying for property taxes, repairs, maintenance, insurance, vacancies, mortgage interest, closing costs, and agent commissions. That 5% appreciation can disappear quickly. Example, your property increases in value by $25,000, but during the year you spend $8,000 on mortgage interest, $4,000 on maintenance, $3,000 on taxes, $2,000 on insurance. Suddenly, the profit looks much smaller. Meanwhile, stock investors can own the entire S&P 500 with almost no ongoing effort. Here's where the comparison gets really interesting. Real estate generates monthly cash flow. Stocks generate long-term compounding. And emotionally, those feel very different. A rental property producing $500 per month feels tangible. You can actually live off that income. Stocks, on the other hand, often grow quietly in the background. No monthly payout, no excitement, just consistent compounding over time. And historically, that compounding has been incredibly powerful. So which investment creates more wealth? The answer is, it depends on the investor. Stocks tend to work best if you want a passive strategy. You value liquidity. You don't have much time. You invest consistently for decades. You don't want to manage properties. Real estate tends to work best if you understand leverage. You can improve or reposition properties. You buy undervalued deals. You manage risk carefully. And you know how to use financing effectively. Many of the world's largest fortunes involve real estate. But for the average person, Historically, consistent investing in index funds has been one of the simplest ways to build wealth. Here's the reality most people online avoid saying. You don't necessarily have to choose one over the other. In fact, many smart investors use both. Stocks provide liquidity, diversification, and passive long-term growth. Real estate provides leverage, tax benefits, and recurring cash flow. Combined together, that can be extremely powerful. So, stocks or real estate? The real question isn't which one is better. It's about your goals, your risk tolerance, your available time, and your skill set. Because the real key to wealth building isn't finding the perfect asset. It's staying invested long enough for compounding to do its job. If you enjoyed this video, make sure to like and subscribe.